Are you a Canadian business owner with retained earnings that are building up inside your corporation? So if you're not putting those funds to work through your holding company, you are missing out on major tax advantages and real opportunities to grow your wealth. Hi, my name is Laurent Munier. I'm a partner and advisor here at Safe Pacific Financial in Vancouver, and we help Canadians across the country, business owners, professionals, to protect and grow their wealth using proven strategies like corporate investing through a holding company. Today, we're going to break down exactly how to invest inside your holding company in Canada and how to do it the smart, tax-efficient way. Now, why would you invest through your holding company in Canada? Well, if you're a Canadian business owner or you're an incorporated professional, there's a good chance that your operating company is generating more income than you need to live on. So that extra cash is called retained earnings, and it can add up quickly. But letting it sit idle inside your cooperating company can actually lead to serious tax inefficiencies or liability risks. And this is where your holding company or your HoldCo can become one of the next financial structures that you implement. So the holding company is a separate legal corporation that doesn't carry out any business operations. Instead, it holds assets like your retained earnings or stocks or bonds or real estate or a life insurance policy. And it does this on behalf of you or your family. So the goal is to separate the operating business from your long-term wealth so that you can invest more strategically and protect your money. So at Safe Pacific, we help Canadian entrepreneurs and professionals to set up and manage holding companies that allow for more control, for more protection, and for more tax-efficient wealth building. Actually, let me caveat that. We work with you to identify when to set up the holding company, and then the lawyer sets up the holding company. We don't actually do the physical writing of the contracts, but we are often the person that says, hey, you should probably think about this. And it's weird that your other advisors haven't told you to do this. So here's how. Number one, asset protection. So when you move your money and your assets out of the OpCo and into the holding company, there's a legal separation between your business operation and your personal or investment assets. So this means that if somebody sues your operating company, your money is separated. It's in the holding company. So this puts a firewall between your operating company and your assets that are inside your holding company. So from a legal perspective, it helps to protect you. Number two is creditor protection. So again, because your investments are no longer held directly in the operating company and they're in the holding company over there, they're less vulnerable to claims from creditors or from disgruntled business partners or legal disputes. So this is really important if you're in a higher risk legal field, say like you're in medicine or you're in law or construction or finance, things where people sue you. So you want to have your money separated from the operating company. Number three, you can have tax deferral and you can plan dividends. So your holding company allows you to defer personal taxes. So when your operating company pays what's called a tax-free intercorporate dividend to your holding company, there's no immediate personal tax. You can then choose when and how to withdraw the funds personally from the holding company. You choose when to pay yourself from the holding company, usually during lower income times or during retirement. So you could also have large life insurance policies inside the holding company, which can grow with tax advantages, and it can provide liquidity through leverage and guarantee your legacy through your beneficiaries. Another thing you want to look at is income splitting and succession planning. So with the right structure, including a family trust, which your lawyer will set up, your holding company can help your income split with your spouse or with adult children. So this also makes business succession and estate planning far more flexible. So you can transfer shares of the holding company instead of liquidating the business. And this will help you to take advantage of the lifetime capital gains exemption and avoid unnecessary taxes. So what is the bottom line, right? A bottom line is the holding company is more than just a tax planning tool. It's a long-term wealth building vehicle. It gives you more control over how you invest. It gives you more control over how you take the money out. And it gives you more control over how you eventually transfer your wealth to the next generation. It also puts, like we talked about, a firewall between your operating company and your long-term savings inside the holding company. So how do you invest inside your holding company? So you're an incorporated business owner, you've got profits or you've got your retained earnings that are inside the operating company. So simply by letting that money sit in a low interest corporate checking account, well, that's a huge missed opportunity. Worse, it could be costing you taxes and it's for sure costing you lost growth. So, we'll guide clients through a smart and structured process that helps you to move that money tax efficiently into a holding company and then invest in a way inside the holding company that builds your long-term wealth and that protects your estate and defers unnecessary taxation. So here's how it works. Number one, you transfer the funds from your operating. Actually, we should back up. Number one is you talk to your lawyer and you get the holding company set up in the first place, right? And you get it set up correctly to be related to the operating company. So step number 1.5, I guess, is now you transfer the money from the operating company to the holding company. And this is tax-free. So the first move, again, your accountant will do this, is you do an intercompany dividend from your operating company to your holding company. So since both the companies are what's called a CCPC, a Canadian Controlled Private Corporation, the dividend is mostly and typically almost always tax-free under these intercompany dividend rules. So again, like I said, your accountant does this, not us. The main reason is to get the money out of the active business and into a structure that's built more for investing or tax planning or asset protection. So you want to transfer the money from the OpCo to the HoldCo. Step 2 is then you invest, right? You're investing strategically in the holding company. So once the money's there, you can invest in all sorts of things. And this is, again, something that we can help you with. We can open all sorts of corporate accounts for whatever your situation is, and then you can put things into those accounts. You can have stocks, you can have ETFs, you can have funds, you can have private equity, you can have venture capital, you can have real estate, you can have commercial real estate, residential real estate, you can have life insurance policies. All right. So investing inside your holding company allows you a range of things that you want to put your money into, but it also allows you to defer personal tax on this investment income. So instead of paying that personal tax today, you can defer it eventually until you withdraw the funds, which could be years or decades later. And then ideally, you're withdrawing the money from the holding company sometime in the future when your income is lower or when you've implemented some tax-efficient withdrawal strategies. So by having the money in the holding company and investing it here and not taking it out, you get to not pay that tax by taking it out, and you get to choose when you get the money. Step number 3 is you want to choose tax-efficient investment vehicles. So not every investment is treated equally inside a corporation. So for example, interest income, which a lot of people like to earn, and this is what you would get from like a GIC or from a bond. Interest income is taxed at over 50% in the holding company in most provinces. So this is a huge tax drag, right? You think you have a great GIC that's paying you 4 or 5%. Well, half of that is gone to tax. And then this is why at Say Pacific, we often would recommend things a little bit different on the investment scale. So say like a low dividend or more growth oriented stocks or ETFs. You can get corporate class mutual funds. You can get capital focused investments. So things like real estate or private equity. And these types of investments, they would produce a more favorable capital gain or deferred income, which is taxed at a lower rate than interest. Number 4 is you want to shelter your investment growth inside a life insurance policy. So this is where the strategy really gets powerful. So by setting this up and by having the life insurance policy inside your corporation, and it'll be a whole life policy, you can redirect a portion of these retained earnings into the policy and then have it grow. So this offers you tax sheltered growth inside the policy, a guaranteed cash value that's going to grow over time. It offers you access to the capital whenever you need because you can leverage against the policy with the bank or with the insurance company. And the insurance one day is going to pay out, right? So one day you're not going to be here anymore and there's going to be a tax-free death benefit that can flow, that pays out to your corporation, and then it can go from the corporation to your beneficiaries through what's called a capital dividend account. And most of that money can probably come out tax-free. It'll just depend on your situation at that time. This approach also bypasses probate. It avoids CRA involvement and it protects your legacy. So it's one of the most tax-efficient ways to invest and to pass on wealth in Canada, especially if you're a high-income professional or if you're incorporated and you've got strong cash flow. So if taxes are your problem, this is one of the best ways to solve that problem. Now, you definitely have tax considerations when you're investing inside the holding company. So investing in your holding company, obviously, it can be a smart way to build and to protect your wealth, but only if you understand the tax implications. So without proper planning, the corporate investment income could expose you to some of the highest tax rates in Canada if you do it wrong. So this is what you need to know. Number 1 is that corporate investments are taxed heavily. Any passive investment income that's earned inside the holding company, so interests or dividends or capital gains, is taxed at a higher rate than active business income. So in many provinces, this can be tax rates of 50%. On interest income, it could be 38% on Canadian dividends. So even capital gains, while partially exempt because you only pay on half, can still carry a significant tax load when you realize those capital gains in the corporation. So as an easy example, let's say your holding company earns $100,000 in interest income. So depending on your province, more than 50,000 of that could be payable to the CRA before you even think about taking that money out personally or reinvesting. Another thing you want to look out for is the passive income grind. So this is a new one, well, sort of new now. It's another layer to the tax problem. Once your passive income inside your corporation exceeds 50,000 in a year, then you start to lose access to what's called your small business deduction in the operating company, in the related company. So again, depending on your province, your small business tax rate is usually around 12-13%. And this means if you're earning less than $500,000 net at the end of the year, you qualify as a small business in Canada, and your tax rate is going to be somewhere around 12-13%. But if you have investments in your holding company and your passive income crosses 50,000, then you start to lose your small business deduction at a 5-to-1 ratio, which means for every $1 of passive income over 50,000, you lose $5 of small business deduction. What does that mean? After you've got $150,000 in passive income, you lose access to the entire small business tax rate. And this will bump you up to what's called the general rate, which increases your operating company taxes, again, depending on the province, anywhere from 13 to 15%. So if you do well, but you make too much money, your taxes in the operating company could go up 13 to 15%. So this means you're not only paying more tax on your investments, but you're also paying more tax on the day-to-day business in the operating company. And that more tax comes straight out of your pocket. And then how do we help you on this, right? So this is exactly why tax planning is so critical when you're investing inside a holding company. So we help our clients protect both their investments and the corporate tax status by implementing smart, conservative, CRA compliant strategies. So number one, what you want to do, you want to monitor and you want to cap passive income across all the corporations that are in your group, because all of the related companies affect each other, so that you can maintain your small business tax rate. Because usually, unless it gets really big, usually keeping your small business rate is worth more than trying to earn more in the investments. Again, case-by-case basis, it might not be the situation for you, but usually that's the situation. You also want to pair your corporate investments with a tax-sheltered vehicle. So again, we talked about participating whole life insurance that you can own inside the corporation. The reason that we talk about that so much is because life insurance is tax exempt, and the growth inside one of these insurance policies doesn't count towards passive income. So it doesn't affect your small business deduction, and it doesn't grind down your small business deduction over time. Another thing you can do is you can reorganize your corporate structure. So this may not be necessary, but if it is necessary, you could isolate your passive income and preserve your operating company's tax advantages. And then we've talked about this a couple times, timing. So you could time your capital gains and you could time your investment withdrawals so that you're taking money out during low income years or other tax efficient years. So by understanding and controlling how the investment income flows through your holding company, you could reduce that tax drag. You can keep your small business status and keep that small business deduction. And then you can ensure that the money that you have inside your corporation is working efficiently for you, not working against you. This sounds all good, but what can you invest in? So some common things that you would have inside a holding company. One of the big advantages is this flexibility to invest your retained earnings in, a real wide range of asset classes. So each investment type, though, comes with different tax treatments. It comes with different risk profiles. It comes with different liquidity considerations, which is why you need some sort of customized plan and you need somebody to kind of tell you what to do. And again, this is what we do. We help incorporated professionals and business owners to build a diversified, tax-efficient corporate portfolio that's designed to grow your wealth, protect the capital, and create a smooth succession plan. So some of the most common and strategic investments that you can put inside a holding company in Canada, number one is just, a portfolio. So publicly traded stocks, bonds, ETFs. The holding companies can invest in Canadian stocks, in US stocks, in bonds, and ETFs. Usually you're doing this for long-term capital appreciation, maybe for dividend income, and these options can offer strong potential growth. But keep in mind, interest income, so this would be from the bonds or GICs, it's taxed at the highest corporate rate. So it's taxed over 50% in most provinces. Another thing you want to think about is eligible Canadian dividends. So these receive a better treatment, but they still have a significant corporate tax. Capital gains is taxed the most favorably out of what we've talked about. Only half of the gain is taxable, and half of the non-taxable portion can also be added to your capital dividend account. So it can be a tax-free distribution to shareholders. So to eliminate the tax drag or to mitigate it, we can often recommend low dividend or growth-oriented ETFs or things that don't pay interest that minimize your passive income. So these are the kinds of portfolios that we would set you up with if you're using us to invest your holding company money. A portfolio manager is the one that would actually construct the portfolio, but keeping all of this in mind. Another thing you can look at is what's called corporate class mutual funds. So corporate class mutual funds are structured to allow investors, especially corporations as investors, to defer or reduce tax on their investment income, and it minimizes the distributions and it allows the capital to grow tax efficiently inside the fund. So for your holding company, these funds are an excellent way to delay triggering taxable events and to maintain more control over when and how you realize that income. So we don't really offer mutual funds. I don't think mutual funds are the future, but a lot of people have mutual funds. So you do need to know about corporate class mutual funds for tax reasons. Then you have real estate. We're in Canada. Real estate is a huge topic and a lot of people invest in real estate. So many holding companies invest in rental properties or, whether that's residential or commercial. And they do it either for cash flow or appreciation or both. And so real estate inside your holding company can provide the steady rental income, long-term capital growth if markets are going up. It can provide leverage through financing against these houses or buildings and potential for tax deferral via capital cost allowance. Again, talk to your accountant about that. However, rental income is considered passive income and it counts towards the $50,000 grind threshold on your small business deduction. So proper structuring is critical to avoid paying way too much tax. Another thing that we talked about is private equity or startups or alternative assets. These are getting a huge amount. These are very, very trendy right now. They used to be for much more sophisticated investors, but now it's really becoming sort of retail-y possible. But holding companies can be used to invest in private businesses, in limited partnerships, or other alternative investments. So these could offer higher returns, but they also carry greater risk generally, and there's also liquidity limitations. So when you're invested in one of these private things, you might not be able to get out. We can often structure these investments through corporate entities or a trust to isolate the risk and to maximize the tax efficiency. Again, we don't offer these, but people do have these, and you should know how to hold it and where to hold it. Another one that I've talked about a few times actually in this video is participating whole life insurance. So one of the most tax efficient investment options for a holding company is a participating whole life policy, so owned by the corporation. So these offer cash values that are guaranteed. It offers tax sheltered investment returns over time. You can get policy loans or collateral loans for the liquidity, so without having to sell anything and trigger the capital gains. And it provides a tax-free death benefit at the end, right? So most of that, if it's corporately held, can be paid to shareholders through a capital dividend account. So corporate-owned life insurance is especially valuable for conservative investors. It's really important for retirement planning and for intergenerational wealth transfer. So if leaving money to your kids or to your family or to a charity of your choice is important to you, this is one of the best ways to do it, especially if you're using corporate money. So you want to have a personalized way to do all this. You want a personalized investment strategy for your holding company, right? There is no one size fits all approach when it comes to corporate investing. Your portfolio really should be tailored to reflect a few things. So your business structure and your income level. For sure, your risk tolerance and your liquidity needs. You want to think about your retirement timeline. Like, are you going to be holding these things for 5 years, 20 years, 30 years? And your succession planning and your estate planning goals, right? So are you looking at what happens to the next generation. So all of these things are considerations that you want to obviously take into consideration when setting up your holding company and when deciding on what types of things to invest in. And when does it make sense to use the holding company? So setting up the holding company or your HoldCo isn't just a formality, right? So for a business owner, or if you're an incorporated professional, it's often a cornerstone of your wealth plan. But is it the right move for you? I don't know. We work with clients every day who want to go beyond just running a profitable business. They want a way to protect their capital. They want a way to reduce their taxes and grow wealth for the long term. A holding company can make that happen. And here's some of the most common scenarios where, the HoldCo makes strong financial sense. So you're incorporated and you have retained earnings in the company. So your operating company generates more income than you need to run the day-to-day business and to pay yourself for your personal spending. So anything left is called surplus or retained earnings. And you probably don't want to just leave it in a checking account. You probably want it to grow, right? So transferring those funds to the HoldCo lets you to keep more money invested and keep it in the corporate environment without having to pay it to yourself and pay income tax. It avoids triggering this tax unnecessarily, this income tax or personal taxes, and it can separate your active business operations from your passive investment out, right? The holding company becomes your long-term bucket to put your long-term stuff in. Another thing too is if you want to grow your investments without triggering personal tax. And this is one of the biggest advantages of using the holding company, is this ability to choose how and when you pay yourself. And, in corporate speak, this is called tax deferral. So when your operating company pays the dividend to the holding company, it's almost entirely tax-free under Canada's intercompany dividend rules. Again, your accountant will do that. And I'm not telling you it's tax-free, but it's talk to your accountant. That means that you can move money between the companies without paying your personal income tax. And this allows those funds to compound more efficiently inside the holding company. Then you invest it inside the holding company. So your stocks, your real estate, whatever, your insurance policies, and you're not paying personal income tax on that until later when you take the money out of the holding company and you pay yourself whatever you need to go buy a pair of shoes or go to the restaurant. Another good reason to do it is when you're concerned about creditor or legal risk. So for business owners, separating your investments from your active operating company is smart risk management. So if your operating company is exposed to liabilities, so debt, potential lawsuits, you've got staff and HR issues, the business downturns, you might be looking at like, oh, I can't pay my bills. Any capital inside the OpCo is at risk, and it's fair game for somebody to sue you and try to get it. So by moving your retained earnings or your surplus to a holding company, you're shielding those assets from whoever's going after your operating company. And it keeps your investment capital protected, even if something goes wrong in the operating business. And then another thing too is if you're planning for retirement or an estate transfer. So the holding company gives you greater control over how and when to access your corporate money. So whether you're planning on selling the business or whether you're passing it on to the next generation, to your kids, or you're going to wind it down over time, with the right planning, the holding company can facilitate. You can then use that for income splitting during retirement. You can distribute dividends tax efficiently through your capital dividend account. You can multiply access to your lifetime capital gains exemption through things like an estate freeze or a family trust. Again, your accountant and your lawyer are going to set those things up. And then it also provides a structure for intergenerational wealth transfer. So often the holding company will have some whole life insurance in it to maximize the value of your estate and to create a tax-free legacy for the heirs. Because by wrapping up your money inside that corporate policy and having that grow and eventually pay out tax-free, it's a really good way for you to basically transfer as much money to the next generation as possible. Now, who should do this? Who should use a holding company? It is ideal if you are a business owner, obviously, or you're an incorporated professional or an entrepreneur where your operating company is profitable and you're keeping money in the operating company every year. So somebody that has this retained earnings built up inside the corporation should look to set up a holding company so you can move that money out. If you're an investor and you're looking to grow your money tax efficiently without having to pay yourself a lot of personal income and paying personal income taxes. If you're a planner who wants liability protection or succession flexibility and estate control, right? So a holding company is not the right move for everyone, but when it's used correctly, the holding company is one of the most powerful tools to build and protect and to pass on wealth in Canada. Just for a personal anecdote, I also have a holding company and it's great. So the way that Safe Pacific is set up, Rob and I own it 50-50 and we pay ourselves the same amount. And then the profits from Safe Pacific both pay to our holding companies. In some years, he needs more money than I do. And I don't necessarily want to take out a bunch of money from the company. Or in some years, I need more money than he does. So say you're buying a house or like your kids are going to university and you're like, I need a bunch of money for right now. The holding companies allow me to take more money out in years that I need more money and he doesn't have to do anything. And it allows him to take out more money in years that he needs more money and I don't have to do anything and it doesn't affect my taxes. So it's a great way to have that kind of modular flexibility on your money without affecting other people. Now, what's next steps? Well, let's chat. We have a ton of content and info. Everything on our YouTube channel is mainly for Canadian business owners and for high-income professionals. We also have a ton of content on our website. It's safepacific.com. And if working with us or, talking about these types of strategy is something that you're looking to do, then you can either schedule a time right on our website or you can send us a message through the website. So it's safepacific.com. Click on one of those buttons and it'll schedule a discovery call with one of our advisors. There's also going to be a link in the video below in the description that you'll be able to click and you'll be able to set up a time to meet with us or you can send us a message. Now, today, this was a huge video. This was really big. So thanks for staying with me all of this time. If you got some value from today, if this helped you to figure out whether you want to set up a holding company or not, please do me a favor. Click all the buttons. That means like, that means share, that means subscribe, that means the notification bell. If you want to leave a comment, all of these things really help to share the message with other Canadian business owners like yourself, and I really appreciate it. So, as always, my name is Laurent Munier from Safe Pacific Financial. We're based here in Vancouver, but we work with clients all across Canada. Thanks for watching. I will see you next time.